These countries are collapsing. I'm your host, Steve Van Metre, and thanks for joining me today. And several countries are now past the point of no return, and the U.S. will soon follow unless the Fed makes a major change. Let's go to Bloomberg, where we picked today's story up with Eurozone's factory downturn intensifies on record inflation, as the manufacturing sector is now clearly in a recession. All the currency bloc's biggest economies except Ireland saw the downturn deepen in October, meaning it's getting worse, according to surveys of purchasing managers by the S&P Global. Spain was the worst hit, followed closely by Germany, which is among the most exposed to Russia's cut in energy prices. And here you can see in these PMIs, and just to remind you of the way we read them, a 50 is unchanged from the month before. Above 50 denotes expansion. The higher over 50, the bigger the expansion. Below 50 means contraction, and that's what we're seeing. Here we can see, we look at the Spanish PMI at 44.7, Italian, Italy at 46.5, French 47.2, Germany 45.1. And notably, there's something real interesting here, because it's not that just these economies that are contraction. There's just something about this magic number of 45. When you start to see these PMIs hit 45, it means very clearly that these economies, the manufacturing sector, is entering a recession. Now, what does that actually mean, in terms of the rest of the economy? Well, the first thing it means is these companies are going to have massive internal cutbacks, followed by, guess what's coming next? You got it, layoffs. And the blame? Inflation. The data are we now clearly signaling that the manufacturing economy is indeed in a recession. And again, another key point here is where the manufacturing sector goes, the rest of the economy follows. So we know that in the past, we see data that shows the services sector lags the manufacturing sector, both to the upside and to the downside. So while we start to see the manufacturing sector here in Europe go down, it means our services sector is soon to follow. And that's a key point. Factors that are likely to aggravate in the downturn include inflation, which remains stubbornly elevated despite continued evidence that supply chain pressures are receding. And there's a lot of evidence of that. Now, we don't have access to charts of the Eurozone PMI data, but we do have the U.S. data courtesy of the St. Louis Fed database. And we know we can look at the Philly Fed current general activity index going back all the way into the 1960s. And we can overlay the consumer price index so we can put to the test, do periods of high inflation lead to manufacturing downturns? And the answer is they do. Note where the red line is going higher, there you see rising inflation, and the blue line heading down with notably below zero in contraction. We can see periods of high inflation do indeed lead to manufacturing downturns, which then in turn lead to services sector downturns, which turn into deflation, or many times even disinflation. So we can see the economy here is absolutely going to slow down here in the U.S., and that is a key problem because, when we think about the global economy, we look at Europe, we have Asia, we have the North America. Do we see them all as separate islands? The answer is no. If Eurozone goes down, it's going to have a broad-reaching effect to the rest of the global economy. Europe is a massive consuming nation or group on its own. They also are a massive exporting group. So when their downturn is happening, it's spreading across both directions into Asia and into North America. It's going to have broad repercussions. We can also note that unemployment will also head higher. Here we can see taking the same Philly Fed diffusion index on general business activity, overlaying the 4-week moving average of initial claims. And we can note that when the blue line gets below the horizontal black line, we start to see an uptick in unemployment. Now, we're not seeing that yet in the U.S., but there's reasons. We'll get to that here soon, because Maersk sees Europe close to a recession. So not only are we seeing it in the manufacturing data, but now we're seeing it in the actual shipping data. And get this, with the U.S. not far behind, as the workhorses of global trade are coming off record profits, and that's not going to last. It's really hard to be very optimistic with a war on our doorstep and an even bigger energy crisis this winter, so that's impacting consumer confidence and therefore also demand. it's quite likely that we will either are or will soon be in recession, certainly in Europe, but potentially also in the US. And again, these things are not exclusive to one zone. The rest of the world is not an island, and that's a key problem because we're globally integrated now. So what happens in one part of the world eventually filters out. But even if it didn't, even if we just focused on the United States here and said, hey, there's a period of really high inflation and it looks like it's going to be sticky for a little bit, how does that impact the day-to-day spending of consumers? Well, when your rent, your shelter costs go higher, when your energy costs go higher, and when your food costs go higher, and your wages aren't going higher, well, what does that mean for your broad spending? You're going to cut back. You have no choice. That in turn causes other businesses to aggressively start to lower prices, to clear inventory, and then if they can't, they eventually lay off. And that's why we see high inflation always leads to recessions. After several quarters of surging profits, Maersk's deteriorating outlook lines up with global economy that's downshifting amid soaring inflation and snarled supply chains that, while easing somewhat, are still dealing with disruptions tied to Russia's war in Ukraine and China's strict COVID lockdown policies, neither of which appear to be changing. There are plenty of dark clouds over the horizon, and this weighs on consumer purchasing power, which in turn impacts global transportation and logistics demand. And again, we go back to what we heard from FedEx when they announced their earnings, and they said, look, around late September, total shipping, global shipping, it wasn't just US, it wasn't just Asia, it wasn't Europe, it was global shipping dropped off a cliff. We're seeing that here now from Maersk saying, hey, we're seeing the same thing. And if that's true, which it is, it means at some point this is coming to America. In fact, it may already be here, just not yet in the data. Maersk, which controls about 1/6 of the world's container trade, said earlier this week that freight rates have come down faster than expected. And get this, warehouses in the US and Europe are filling up as consumer demands for goods declines. And that's what we've noted. And when we look at all this factory data, why are new orders going down? Because warehouses are full. They can't move the inventory. They can't get it off the shelves fast enough. And of course, that means cancellation of new orders and eventually more layoffs. And you can start to see that what's coming or what's happening in Europe is now a matter of months away from what's coming to America. On Wednesday, the company said that global container market is expected to be broadly flat to negative in 2023, with risk skewed to the downside due to the macroeconomic outlook. I'll say at least skewed to the downside, if not more. But now let's look at the U.S. because we have some news that, of course, here is going to drive the Fed decision. And what I want to suggest to you is the Fed is not just making a mild policy mistake, they're making a massive policy mistake. I don't know what you think about that, but I'd love to see what you weigh in the comments. Is the Fed on the right track, or are they about to blow things up? Here's what the Fed's looking at. The U.S. job openings post-surprise increase, keeping pressure on the Fed. And sure enough, the number of available positions increased to 10.7 million in September from a revised 10.3 million a month earlier, according to the Job Openings and Labor Turnover Survey, or JOLTS. And what we can note about the JOLTS survey, which is something that I don't think, in fact, if one of the least credible surveys, our government does is this JOLTS survey, because as I'm about to show you and you've seen before on the show, it's really just a proxy of the U.S. stock market. Where the market goes, job openings follow. And it's really just that simple. Here you can see in blue, job openings, total non-farm, and it lags the stock market by about 2 months or so. Here you can see the Wilshire 5000, total U.S. stock market in red. And no surprise, the market went down, job openings went down, the market bounced up, and lo and behold, job openings bounced as well. The ratio of openings to unemployed persons rose in September. There are now some 1.9 available jobs for every unemployed person, compared with those with 1.7 in August. This is something the Fed officials watched closely and pointed to the elevated number of job openings as a reason why they can continue to tighten despite a cooling economy. Is that true? Are you seeing that out there? If you're on the unemployment line and you're going to look for a job, are you seeing all those openings? I'd love to know. U.S. firms added 239,000 jobs, saying, look, the U.S. economy is indeed robust, but maybe underneath the covers, it's not what the headlines suggest, boosted, of course, by the leisure sector, and for good reason. We're heading into the holiday season. And note that leisure and hospitality jobs jumped almost most of the report, followed by trade and transportation. And again, you think about what things go on during the holiday season, and what would you expect? Leisure and hospitality jobs? Yes, you'd expect that. Trade and transportation? You'd expect that. But now let's take a look what's happening beneath that, and you can see the real problems of the U.S. economy are already starting to show up. Natural resources and mining. Think of the oil market. Some job increases there, but not substantial. How about construction? Pretty much even on the month. No major change there. But look at this financial activities. You start thinking about people impacted by higher interest rates, people in the lending business. 10,000 jobs lost. Professional business service, 14,000 lost. Information technology. What did we hear from these tech companies? They're laying off. 17,000 lost. Manufacturing sector, again, leading the broad economy, 20,000 job losses. So a robust report? Not quite. The report also includes fresh insights into wage growth, which has been among the Fed's main concerns as recent gains fuel consumers' purchasing power and add to wide price pressure. Those who changed jobs experienced a whopping 15.2% pay increase from a year ago, extending the string of monthly decelerations that suggests workers' bargaining power may be starting to erode. For those who stayed at their job, the only pay went up 7.7%. So now this takes us into the Fed meeting, because I started out the show talking about how the U.S. economy is headed down the same path unless the Fed makes a change. It means they need to pivot. And what were we looking for in today's FOMC press conference wasn't that there was going to be a rate hike. That was baked into the cake. What we wanted to hear was, when was the Fed going to start cutting back the pace of their hikes? Where was the terminal rate? When were they going to pause? And let's take a look at what they said, and then we'll take a look at what the market's saying the Fed is actually going to do. Recent indicators point to a modest growth in spending and production as job gains have been robust and the unemployment rate has remained low. Inflation remains elevated, but we already knew that. And so the committee seeks to achieve maximum employment and inflation at the rate of 2% and decided to raise the target range for the federal funds rate to 3.25% to 4%. And they anticipate that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation down to 2%. But I can make the argument that monetary policy is already at a level that's restrictive, because we're seeing that across the economy as it starts to slow down. We're seeing the bond market signal that. But what we can take away, at least initially, as we got into the press conference, that Powell kind of was wishy-washy, that perhaps indeed December could see a slower pace, although he did mention the terminal rate went up, but he didn't say to what number. He didn't want to say that, because I want you to see there was a change in tune. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags in which monetary policy affect economic activity and inflation, and economic and financial developments. And that is the key change. Remember, we talked about the pressure, just in the show yesterday, that the Fed was getting from Congress. We've talked about some blowback he got from other members of the FOMC board that said, hey, they wanted to slow down. They wanted to take a look. Because remember, we go back, it wasn't until March of this year that the Fed started to tighten. And if, again, Milton Friedman is right with the monetary lags being between 6 and 12 months, we haven't even got to the point yet where perhaps those tightening of back in March are actually hitting the economy, suggesting that the Fed did need to make a change of the tune. But why did Powell do that? Well, why did this language get into the press conference? I'll show you why. Because voting for monetary policy actions, well, was everybody. And so how do you get everybody to go along with your agenda? You start to give some back of what they want. And I think that's what he did here. I think he knows he's going too far. In fact, at his press conference, he was asked about the 3-month 10-year yield curve, which we've talked about was a great indicator. And he said, no, I think we have higher to go in the federal funds rate. We're not restrictive yet, and we need to get there, and then we'll hold. But check this out, because the bond market is saying that by December, it's already too late, and the pause is imminent. Here we can note the 10-year Treasury minus the 3-month Treasury constant maturity yield curve in red. Every time it's below the black line, what do you see? Peak rates in, of course, the federal funds rate. They go to a mode of pausing. The curve steepens, and it's all over. The curve is just slightly above inversion. Inverted the other day. It normally does that where it will invert. It'll uninvert, and then when it reinverts, then it's game over. And this time, it's absolutely game over for the Fed, telling us by December, even though they're talking big, they'll be in a mode to pause. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.